Hi everybody, and welcome back to FANG Friday. We're going to vary the format somewhat this week in order to help our viewers to understand a lot more clearly what I've been saying each week. We've received a couple of emails from our viewers who are very curious about those lines that I keep referring to as breakpoints. One viewer wrote, "It all looks interesting, I think, but I need to know more. Where do they come from? What do they mean? And how on earth would I ever use them if I took your service? It seems as if there are so many of them, and there are so many numbers to remember. So Ross, enlighten me." Okay, Mr. Viewer, and it was a Mr. Thanks for taking the time to ask us how the market actually works, at least as we see it. Let me start with 3 central points, and then we will look at some charts to see the practical applications of what I am going to talk about today, and hopefully you will see the value as an investor. First and foremost, do such breakpoints actually exist? Well, the answer is a resounding yes, and indeed things do happen at those breakpoints. If they did not, then all of those academics with their chatter about efficient markets and the random walk of stock prices would be right. And that would mean that all market technicians would be little more than Ouija board artists trying to create meaning where no meaning exists. Also, and perhaps more profoundly, it would also blow any rationale for active portfolio management out of the water, because there would be no information value in price. So what I'm saying is there is a science behind technical analysis. There, I said it. I hope all of you technical analysts who may be listening are feeling better already. For the rest of you, never laugh at technical analysis again. Although, to be fair, after today, you will be entitled to ask them where his or her breakpoints values actually come from. So, where do they come from? The answer is that they flow from the mathematics of accounting dynamics, discovered and developed by the late Dr. Vern Attrell. In other words, they flow from that most critical and fundamental document, the balance sheet. They are price to book values. And that's why all those lines that you see are all parallel. They are multiples of book value, but not raw book. There's a sort of an X factor in calculating a usable book value. You see, you just don't take a bunch of people, pens, computers, desks, machines, and some inventory and call it a company. Somebody has to organize it into a business. The X factor that we add to the raw book value is what Dr. Attrell called the value in organization, and that number is proportional to the size and the structure of a given balance sheet. That means, unfortunately, that you can't just take our numbers for your breakpoints and do it yourself. Well, okay, so what are the values themselves? The answer is that they flow from and are proportional to the structure of the balance sheet itself. In Chapter 3 of my upcoming book, Inside the Market, it tells you in excruciating detail where each breakpoint comes from. Go to strategicanalysis.ca and give us your email address. You can download the first 2 chapters of my book to see if you want to go any further. It's all free. Now, I have to tell you that there are a lot of breakpoints. Oh man, are you kidding me? How am I supposed to remember all that stuff? Well, you don't have to, as I put it all in a nice little table of values to save you the effort in my book. Although perhaps if there's enough interest from the viewers, we could publish that table on our website for you all. Now, in regard to all of those breakpoints. Think for a moment. Let's say that we have a given stock and it can move from, let's say, 10% of book value to 25 to 50 times book value. And by the way, there's lots of companies way up there, including some of the FANG stocks. That's a lot of space in percentage terms. If there were not a lot of breakpoints, which you should probably think of as short-term targets, if there were not a lot of breakpoints, the market might as well be a random walk. A typical market technician rarely says, hey, I think the stock is going to move up 100% or 260% or whatever, does he? What would he have to say in between? Nothing? So, no. What he looks for are bite-sized increments, 15, 20, 25%, ups and downs. And guess what? He's right, because that's the way the market works as well. Mathematically, the widest breakpoint spread that we have discovered is 39%, but mostly the breakpoint distances are in that 15 to 25% range. So the last question, why do the breakpoints all have funny names? You've heard me call them mid-super growth price, bubble price, and so on. Why don't we just call them 0.5 times book, 3.5 times book, 7.4 times book, or even 20 times book, or whatever? Well, there are two reasons. First is because that book value is not the book value, but is an adjusted book, as I said right off the bat. Secondly, we got here first. We can call them anything we want to. Although actually, we have given them names which best represent what I would call their growthiness. However, with every chart, we do give you an option. You can click on one chart, which shows the lines with our names, and another chart that shows the price to adjusted book value for each of the lines. Anyway, enough chatter. Let's look inside the market. You've noticed that the lines in our charts have different colors, and they are used to differentiate the various zones of growthiness from very high to very low, and indeed even negative. So I'm going to start with the bubble zone, and that's this sector up here. That's these purple lines up here. Because their rate of growth is very high, but usually it's unsustainable, and therefore, while they attract a very high price to book value now, their bubbles tend to pop. And of course, turning to NVIDIA, that's already happened actually 3 times before, but the first one, the last one that we see here happened in 2007, 2008, where the company went from about 34 down to 6. That's quite a pop. I kind of think that something like this is lining up to happen again with NVIDIA. Anyway, as long as the bubble price, which is 7.4 times book value, that is, by the way, 1 over E squared, if you want to know the precise mathematical definition, the bubble price there of 127, as long as that holds, then the company is probably, I guess, what you might call okay. Unfortunately, the fair market value has been slipping, so this great surge of growth is perhaps over, and we're not calling collapse as of yet, but we are very watchful that something like that might happen. So do I think that all the FANG stocks are heading for the high jumps? Well, fortunately, I don't have to think, because the market will tell you when to jump ship. Now, let's look at Amazon, one of our FANGs, to show you what I mean. Amazon's balance sheet has been growing at a rate of 33% per annum. But this stock has broken badly before, not for many, many years, but it has before. We are optimistic, but we're very wary this late in the market cycle. If that level, the HB3, which is 16 times book value, does not hold, then we suspect that something at least of this magnitude will occur again. But the fair market value, look where it is, $556. That's 71% lower than the current price, would take you down somewhere like this. So yes, we're willing to stay with it as long as it stays in that nice range between HB3 and 4. But we are also very wary that something could change. Looking at Netflix, I think that we can see very clearly. Now, this company has had about a 30% compound growth rate of its book value as well. But when you look back, you don't have to look back all that far in history, and you see already that Netflix had an enormous drop in 2011. Could something like that happen again? Well, with all those new streaming companies coming into service, could it happen? But look at the rate of the earnings growth recently. It's been slowing down. I would be watching these breakpoints very closely to make sure that my Netflix shares held in. The second zone, which we have delineated by the orange lines here, we call the super growth zones. It usually contains companies that persistently grow in the region of about 15 to 20, maybe 22, 23%. And here we find our good friend in FANG, Alphabet. Now, Alphabet is growing at a compound rate here, the balance sheet, of about 13.8%, which is why it is as cheap as it seems to be in price-to-book terms, say compared to Netflix or to Amazon. And then there's Facebook, which is not much more highly valued than Alphabet. Its balance sheet is growing at a rate of about 20% compound, and is why I think that it does not want to break much above its mid-super growth price, which is about 5.5 times book value. Now, maybe that new cryptocurrency is going to keep them up there for now, but we watch that breakpoint very, very carefully. Finally, let's take a look at Apple right now. Now, Apple is a kind of an interesting stock because look at, they had this very fast rate of growth of the balance sheet, and then the balance sheet is kind of slowed down here. Apple has been actually really fundamentally kind of tracking at its peak, its fair market value. That's the dotted line. The fair market value, by the way, will be a discussion for another day. But the stock pretty well maxes out at its fair market value. And if that happens to coincide with a breakpoint, which in this case is the bubble price, 7.4 times book, then that forms an unusually difficult barrier to break through. Well, anyway, that's all of the FANG stocks. But there are 3 more zones to look at. So you can either shut me down now or stay tuned and see what else could lie ahead. Well, we can look at the growth zone, and that's bounded by the growth price on the bottom, that's 2 times book value, and the super growth price on the top, that's 3.5 times book value. Here's where we typically find companies growing at a persistent rate of roughly 10 to 15% or so. Now, United Technologies is a terrific example of a stock which, as I might say, knows where its place is. 10% compound growth rate with short bouts of as much as 13 to 15%. Let me click on my price to book box and we'll take another look at it. So here is a stock which has been trading between its mid-growth and its super-growth price for the past 10 years. And that's the way that it should be according to its growth rate. Let me now switch to what we call the normal zone. And the normal zone is bounded by the blue price on the bottom, as we will see in a moment, and the growth price on the top. The banks, the Canadian banks in particular, are terrific examples of companies that have traded here forever. And look at the TD Bank. It's just been trading right along either side of its normal price, which we define as a price to book of 1. Although, again, remember that if you look at the actual book value of TD, don't be surprised if it isn't $72.60. Okay, it's something much lower than that. One of the peculiar things that we have noticed over many years is that the banks, the Canadian banks in particular, never seem to get up to their fair market value. In a sense, I don't know why that is the case, but in another sense, I do. And that is to say that remember that the assets of the banks are the balance sheets of other companies. So perhaps the market is wise to discount the balance sheets of the banks by as much as they do. But notice how regular that the TD has traded over many, many years. Anyway, I'm going to end my discussion of the breakpoints by looking at what we call the blue zone. The blue zone is the place for stocks to go to die. Stocks here tend to be characterized by balance sheets with falling book values, or by stocks which investors think have balance sheets that will suffer from a declining book value. In the past 4 years, 2 of my most profitable recommendations have come from here. But you've got a lot of work to do here, as you must verify the integrity of the balance sheet now and also going forward. I've used the stock of Baytex Energy, and here, when everything was fine, the stock was, well, actually almost got up to its bubble price, very profitable, but then with the collapse in the price of oil, something peculiar happened. Okay, the balance sheet sort of began to disappear under the investors' feet. This stock is going to have to prove that it does not belong here before it will earn a get-out-of-jail-free card. Finally, let me take a look at the U.S. banks, and in particular, Citigroup. The U.S. banks all fell into their blue zone in 2008-9. See what happened here? That's when they had to write all of those funny mortgages off. And since that time, they have been actually subject to a lot of regulatory harassment, fines, and various penalties. And, quite frankly, they need to earn the regulatory respect and the trust of investors. Now, finally, poor old Citigroup mustered up enough strength here to get over the blue price and actually ran up a couple of breakpoints to what we call the low mid price, and that's about that's roughly about 0.8 times book value. However, look what happened. We got into that market correction there that ended in December of 2008, And boy, the Citigroup Bank just turned tail and ran. The Americans are taking no chances with their bank stocks. I hope that you've enjoyed our little journey inside the market. It's not enough to know what the price of a stock is. It's also very useful to know how and why the price is what it is. I should add one final observation. We have tested the SVA breakpoints in virtually all global markets, including China and Japan, and thus far, we have yet to find a market where they do not work as I have laid out today. This is Ross Healy, Chairman of Strategic Analysis Corporation, reminding you that nothing, including investing, is difficult if you have the right tools. See you next week.